Vanakkam, Namaskar, and hello to all the viewers and listeners of this edition of Fixed Income Markets with Sundaram Mutual Fund. In no surprise to the market, as expected, the Monetary Policy Committee raised the repo rate by 50 basis points to 5.4%, with SDF rate, which is Standing Deposit Facility rate, at 5.15%, and Marginal Standing Facility rate, which is MSF, at 5.65%. CR remained unchanged at 4.5%, and MPC retained focus on withdrawal of accommodation. Although be it the quantum was on the higher side of the expectation. The surprise was more on the language, where the central bank sounded hawkish, particularly giving no guidance on the terminal repo rate, which the market had paired on the falling price pressures and a normal monsoon progression. In our opinion, MPC has acted on considerations pertaining to external stability and chances of producers passing on price pressures to the consumers, keeping the inflation trajectory higher. In the global backdrop as well, the central banks, particularly the developed market central banks, remained hawkish by raising rates in larger quantum, namely ECB, Federal Reserve, BOE, Bank of England, etc. Although headwinds in form of slowdown on growth has begun, with high frequency indicators showing a decline, this has resulted in the expectation of rate hike cycle being shorter than initially expected. Having said that, it is imperative to note that inflation expectations are varied across countries and is a function of any key commodity which the country does not produce on its own. In this regards, India is facing heat as the trade deficit numbers have been rising on account of imported goods, both oil and non-oil, namely coal, fertilizer, etc., showing still resilient demand conditions in India. Trade deficit of over $20 billion has been there since the start of this calendar year and is headed upward, the latest number being over $31 billion. This is on account of the key commodity prices remaining elevated. In our opinion, as highlighted in earlier episodes, MPC and RBI has been hiking rates to keep India on track with other currencies and stem the short-term dollar outflows. In our opinion, liquidity is likely to be kept on a tight leash to anchor inflationary expectations, and with busy season and festival season around the corner, currency in circulation is likely to rise from here. This is likely to keep money market rates more volatile and on a higher trajectory. As MPC takes the repo rate to a neutral rate, which is currently perceived by the market to be 6% and being priced in the swaps, substantial change in this view depending on the inflation outcomes, the rate can rise or fall depending on where the final terminal repo rate settles. With monsoon being normal, it is expected that winter crop will cool off the prices of vegetables, fruits, pulses, etc., bringing down the food inflation. Having said that, winter global energy demand will determine the import bill for India, and in turn, the action from RBI depending on what is the kind of trade deficit numbers we print and what is the kind of current account deficit we print. We expect the 10-year bond yields to find resistance at 7.5% levels and money market rates to remain elevated on account of system liquidity tightening in the backdrop of banks raising deposit rates as the credit offtake has picked up and likely to catch steam. It is pertinent to note that after a very long period of time, the wedge between deposit growth and credit growth is widening and is likely to put pressure on system liquidity. Demand for funds in the onshore market is likely to continue as we see the developed market central bank raising rates and withdrawing liquidity, making it costlier to raise offshore liquidity for corporate. This is likely to again keep the demand for funds strong. As in earlier episodes, we recommend short-term investors up to 3 months to continue using the shorter duration buckets, overnight, liquid, ultra, and money market to manage their cash flows, while clients with 9 to 12 months of investment horizon can look to deploy monies in active duration strategies like low duration and short duration funds. Clients with low credit risk appetite and investment horizon of 2 or more years can look to deploy in laddering strategies using high quality funds like banking and PSU. The younger investors who are looking fixed income as an asset allocation for retiral income can look to systematically deploy in very long duration funds. Although in Sundaram we currently do not have a long duration fund, but we believe that anybody looking for retiral income having fixed income as an asset allocation strategy can use long duration funds with duration in excess of 10 years to achieve their retirement goals. Thank you for joining. See you in the next edition.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.